value a stock in 2022. We learn in school that stocks are perfectly priced in according to the latest news available and future expectations. That means that the market is always right. No, the market is irrational and driven by sheeps and algorithms, controlled by big money that is betting short term on momentum. The stock goes up, they buy, the stock goes down, they short. The short term price movement is totally in their hands. As retail investors, we are screwed. No. In the short run, the market is a voting machine, but in the long run, it's a weighing machine. Valuations of companies are based on how much money they earn. This is represented by KPIs. If the stock price will balance out in the future, and we know that in short term it's a casino, the answer is simple. Focus on the long term. The retail investor has a significant advantage versus big money. Time. Time can be used in different ways. Time in the market, time to research individual companies. By researching companies, you can find two things. Companies are not valued correctly against the profits they are making. Companies are not valued correctly against the profits they will be making. In history, people have used time and research to beat the market and earn shitloads of money. How to value stocks against the profits they are making? Easy. First, stock price does not say anything. Oh, Apple stock seems to be cheaper than Facebook. No. The answer is look at market cap. Market cap means what is the total worth of a company in dollars. This is the first thing to look at and how to rank valuation of companies. Currently, Apple and Microsoft are the most valuable companies in the world. Next, you want to divide the earnings they are making versus the market cap. This is called the PE ratio. Price to earnings. PE ratio is good for measuring how profitable a company is versus its valuation. The average PE ratio of a growth company is between the 20 and 25 times earnings. For a mature company, this should be between the 5 and 10. Next up, the price to sales ratio. This shows the market cap versus the sales of a company. 1 or 2 should be a good number for companies that are not growing. If the company is growing, it can be between the 4 and 6. If you're doubting whether a company is expensive or cheap, have a look at market cap, PE ratio and price to sales ratio as the starting point. The thing is that these metrics do not work for growth companies. Companies go through different stages in their life. At the moment of growth, the company needs to invest everything into growth with little profitability, making these metrics worse. Growth companies offer volatility and in exchange, exciting returns. It should be a huge part of your portfolio if you are young and still have time in your favor. If you really want to know how to value these growth companies, watch this video next.